Welcome back to the Deliberate Leaders Podcast. I am your host and executive coach, Allison Dunn. Today, we are going to be talking about how to increase the value of your business by beginning with the end in mind. Our guest is Ryan Tansom. He started his career at his family business, where he helped them turn the company around and ultimately sell it for 8 figures. He took this experience and founded Arkona to create the intentional growth framework, which helps business owners with educational training, fractional CFO services, and strategic planning. Ryan's also super cool and has a popular podcast by the name of Intentional Growth. Ryan, thanks so much for joining us here today.
Oh, Allie, I'm pumped. I'm very excited.
Me too. So I love to kick these off with a deliberate conversation. What would be your number one leadership tip for our listeners today?
Getting alignment on the long-term goals that are not just the surfacey goals of, hey, we want more revenue at a point in time, but like actually like a multidimensional goal that's at a point in time. So we understand how all of our decisions today are making us, getting us closer to that goal or further away, but we have a way to course correct because it's clear where we're going.
Yeah. So I just feel like alignment in general inside of a business is really critical and important. What is the most common thing that you feel people are misaligned on?
So there's a bunch of these topics that I can unpack, and a lot of this comes from like with that family business. I ended up being the executive vice president. So like I was the key employee, my dad was the owner, and all of this was convoluted as all get out, Allie. And so
I come from a family business.
Yeah, it's just every topic hit the blender, swirls together, and you like, again, as we're rolling into Turkey Day here, it's like hopefully we have good Thanksgivings, but some of these concepts, Allie, that I like to unpack that have helped me in essentially wish I would have known this stuff back in the day. It's like this, when people need alignment, it's what is the separation, or not what is, making sure you're clear in the separation between your ownership in the equity of the asset that you own, and then your W-2 wage leadership role. Like, you got to separate those two before we even have any conversation. Because I get dozens of calls every single week, Allie, of people going, Ryan, I want out. My response is, out of what? Your job or your asset? And then they just stare at me. And the final point on this is why that is so necessary, Allie, is because how you handle what you want with this asset and what you want from it is different than what you want from your job that you have duties for. And like with my dad and I, or any, executives at the very, very top in every boardroom, every conversation, every executive, room that they're having these conversations, if we don't tie where we're going to a target equity valuation in a point in time, then it's not clear of, like, let's say we had $1 million in cash flow. I live in Minnesota. So you got, like, let's say 350 grand in taxes. What the heck are you going to do with the rest? Right. Like, are you going to take money out and buy a boat, cabin, cars, investments, whatever? Or are you going to reinvest it for an ERP system, this, that, or the other thing? If we don't even know how much money is available for us next year, right, how are we going to have a good conversation?
Right. Okay. I appreciate the distinction, and also like the question, do you want to be out of it? Do you want to be out of a job, or do you want to be out of the asset itself? Which, is an eye opener when you ask the question.
And the answers are different.
Yeah. Very different often. I would super appreciate it if you would kind of just walk us through and sharing a little bit about your story. I think there's the compound of the complexity of a family business, but obviously you were not the succession plan. So there needed to be an exit plan of some sort. So tell us about that, and then what has brought you to where you are today.
And the complexities of a family business, it's just people and emotions, just like any other business with people and emotions. And it's like, again, the convolution of like the job and the asset. So like what happened was, Allie, so my dad started our family business in the early 90s. He mortgaged our house and bought $250,000 worth of old Panasonic copiers. Like super sexy, one employee, and then scaled the business up. We hit about 21 million in revenue, 115 employees, 3 locations. I worked in another business my entire life, way back before copiers were even networked. Then in 09, I joined full time. He had been very distant from the company. He had some personal stuff going on. He had let the GM at that point just keep the thing going because there was a lot of cash flow involved at that point. 09 happens. Everybody had their own story from 09. The market, really, there was a huge margin compression, if not elimination of the margin on the equipment, which was about a third of the revenue on 20 million in revenue. So when I started full time in 09, I ended up I had a blissful 6 months of just being a salesperson. And then I ended up getting dragged into all the CPA, the bank meetings, all that stuff. And I'm sitting with my dad at the end of 09, and we lost like $950,000 that year. So my dad and I had no choice. It was like, okay, well, we can fold shop here and figure out what we want. But we did what everybody probably listening would do, is we doubled down, and we spent the next 5.5 years turning it around. And from the point of I'd replaced about 50% of the employees by the time I was 25. We sold a couple branches for cash, built out the document management and IT services, rebranded so we could go head to head with all the other tech providers, and got to this point, Allie, where we're sitting again in those conversations in the boardroom, quote unquote boardroom. I mean, it was just a conference room, but he's like, I want out. I hate this, blah, blah, blah. And I'm like, rightfully so, a lot of people get exhausted, but we'd have meetings with CPA firms and banks and attorneys and Vistage and all these places. And we get these little fragments of information. And we're like, oh, that sounds really cool as a puzzle piece of a strategy. We come back what does that mean to us? I don't know, just sell more stuff. And so it was just not a lot of three-dimensional view of what does this all mean to Ryan and Corey. So we felt so trapped from those repeated conversations. Let's go back to my first comment. We didn't have clear visibility into the cash flow, what my dad wanted for distributions, what we wanted for reinvestment, and how that was tied to a target goal. So me and my dad didn't have alignment. So ownership and executive team didn't have alignment. So then it was we're selling, we're not selling, we're selling, we're not selling. Are we can do that ERP project or not? Are we going to hire those people or not? And it's just that whiplash. Finally, we ended up selling it in 2014, which is a very difficult transition period. And I'm happy to share more about that, but kind of led up to the 2014 event.
Okay. So do you consider the sale of that to be successful? Did you feel successful being able to sell it?
Just kind of ties into what is your or anybody's goal. And this is the multidimensional goal. Usually people say, my BHAG or my VTO from EOS is 10 million, 20 million, or 50 million in revenue, whatever. I had a $20 million business that lost 900 grand. So I don't care if you have 20 million in revenue. I'd rather have a $2 million company that kicks off $1 million in cash. So first of all, it's what's that long-term target for us? What we ended up, when you say, was it successful? If you looked at the deal and just at the net proceeds waterfall calculation, and you talked to all the suits involved of the transaction, everybody hey, killed it. But if you're only talking about the purchase price of the sale, what did you want from your legacy? What did you want with your employees? How about the community? How about the baby that you built and all the strategies that you had? By the way, I had to lay off 60 people when we sold, paid a lot of taxes, paid a lot of debt. And what's your definition of success? It would be how I would rebuttal with that question.
Well, I appreciate that, because I feel sometimes people end up going we sold it for 8 figures, and it's
who cares? Seriously.
What did that mean? Right? You know what I mean? Million. It's not figures, it's the impact and the impact.
Well, and I also first of all, I could be sitting there and I watched a panel a couple of weeks ago too, because all the people are talking. People talking about X's all the time, but I sold it for $20 million. So what if you owed $30 million? You owe someone 10 million with no company. So how many partners did you have? Again, there's so many questions to ask.
Yeah. So I appreciate that. I think that this is the part that most people, there's an ego involved where people go what they sold it for versus really, what did you end up with at the end of the day? And ensure that those are in unison as all the blood, sweat, and tears that you put into it. So, so congratulations on the sale of the family business. I guess I would say, that has now brought you to creating, Arkona. So, can you tell us what are, I guess there's some fundamentals that you've kind of built this around. Can you kind of share what that intention is about?
Yeah. And Just like as a side note,
Yeah.
the deliberate word and intentional, like when I ask everybody on my podcast, like, what's your definition of intentional? I bet you half the time they use the word deliberate. So it's like, we're very much aligned here. Yeah, I know. I love it. So Allie, what ended up happening was like, I mean, when we sold, I actually had to call everybody back into the office, and then we ended up, the buyer room, they took 33 out of this 90 people or something like that. Very hard. I lasted 60 days. So I'm gonna like do a couple of like hops to where we're at now, and because it's all the why of what we're doing now. So I could have gone into investment banking, private equity, after people end up going, so like, oh, now I get it. Then they become, I don't want to say it's part of the problem, but they become like investors in private equity firms, or they go out and like go buy other people's firms or whatever it is. But it's like, I was sitting there talking to all my friends from Vistage or other entrepreneurs. I'm like, what the hell happened here? Like, I had no control over the biggest event after 20 years of building this business. And then it's like all these suits are talking to each other and telling us what's happening. And then all of a sudden, bloop, out pops a result. And I was like, it's like going to the slot machine and just like hoping for the best. And so what I was like, I really, as an entrepreneur, love control. That's why I'm willing to take all the risk, because I want autonomy and control with the risk. And I had none of that at the deal table or for my outcome. So what I started doing is I was like, and this is as EOS is kind of taking up steam and scaling up and all these different systems. And I was like, I like after a lot of conversations, Allie, I realized that I was having to spend a disproportionate amount of time with my buddies or friends or entrepreneurs or executives, giving them the level of understanding of like, okay, like, let's get you up to speed of all the stuff I dealt with how valuations work, how deal structures work, how financials work, how like, the systems and processes and procedures and people are valued inside of a company, like what truly creates value. Once we get up to speed, then we can finally get to the heart of the good conversations of high level strategy. But I couldn't do it until we were talking the same language. So what I wanted to do is truly like teach people how to fish, like in the spirit of, I want control, instead of becoming a consultant where I did like suck off the cash flow of some other entrepreneur that built something really hard. Like I'd say, like, here's how to do it. Truly, like, here's how valuations work. Here's how to grow value. Here's how you can monetize it. Like, here's how you can step away. Like, here's how it all works. So I love creating simplicity out of complexity. It's like one of my favorite things to do. I mean, that's what I did when I built up the managed IT services and productizing services. And so it really, now I'll skip to after 9 years, figuring out the messaging. It was not easy at the beginning, but intentional growth, the program, Allie, is helping people view and run the company like a financial asset. And there are 3 outcomes. There's 5 principles to help people think like this and through a lens.
Can we cover just, I wanted like for people to go, okay, these are the 5 outcomes and these are the 3 lenses. And then, you know what I mean? If they need to get more educated on that, they may know some of them. So what would be the 5 outcomes?
So there's the 5 principles and there's the 3 things that helps you. No, but it's okay. So the 3 things that these five principles do is they help people understand what they want from the business and why. The second one is help them clarify a target equity valuation at a point in time and the income they want along the way. Because if you're not going to take a salary or distributions for 10 years and then you got the income towards that equity valuation is crucial. And then the third one is, how do you want your leadership role in the business to evolve or transition out? These 5 principles help people think about it. And so there's 5, and we'll just do a quick flyby if you want.
That's great.
So the first one is your vision. What do you want from the business and why? The second one is your financial targets. And there are 3 of them. What's your target annual income? What is your outside net worth? Just because it'll help understand your options. And the third target is the equity value of your company now and into the future. The third principle is your exit options, because there's 5 of them between internal transfers, search funds, ESOPs, private equity, and strategics. Every one of those exit options will impact the first 2 principles. It'll impact what you want. It'll impact your financial targets. So we have a lens now to view the horizon. It's not about selling, but it's saying like, hey, if I'm building an asset, I want to know how to monetize it. So then the 4th principle is grow value. And it's truly about focusing on growing the equity value of your company by creating sustainable, predictable, transferable cash flow. The 5th principle is your team of advisors. You don't have to be the expert in all this stuff, but all of the people around you need to know where you're going and why and what's important to you. And then they can be the ones optimizing your plan along the way.
Okay. Love that. What is of the principles, what do you think is the most challenging for your most typical client that you're working with? Where are they stuck?
It's,
Yes.
I don't know. It's a really good question. We've had 450 people over the last 36 months go through them. And the five principles, we call them a framework, because if you pulled one principle out, they don't work. You know what I mean? Like, so it's really weird. Like if you were to go through it, you might be a financial wizard, but like have no idea what you want. And then like Sally could go through the podcast, go through the training and have like so much clarity on what she wants long-term and have no idea what EBITDA means. So like the interesting part is it's like a net. It's like a catch-all of helping people like round out what their gaps might be and truly shift their mindset. So like someone that came out, it's like, hey, it's like I took the pill in the Matrix. So you could be like almost conscious, but like you're kind of like completely like, oh, I get it, is the only way I would describe it. So I don't know if that's a cop-out from answering your question.
No, I think it's fair. I think it's obviously unique in each one. I wasn't sure if it was just more common on the financial management side, or if it was on like just the visionary of where it is we're trying to go.
Okay, fair enough. And with that clarity, I would say like so we started our business in early 2019 with the training program, and we digitized it with COVID, obviously. And then so what happened was, to more clarify or clearly answer your question, is like almost every time people would walk up and be like, oh, I get it all now. What the hell do I do with the numbers? So the financials, actually the market pretty much demanded that we build out our financial dashboard offering and the CFO offering. So like we had no intention, which is ironic enough because of the name of our business and program, of building that out, because we were an education company, but so many people needed help on the numbers that like we were forced to, because that was the first step to actually getting the clarity that they needed.
Yeah, I think in my experience, I found that a lot of people can do a lot of really great things with good intentions and even just a vision, and maybe out of just a bit of luck, not really understanding the finances of it. And they sometimes do it really well, or hire people who can help them do it really well, or that is their downfall.
I agree. And I also think that the last 12 years of a complete bull run, like realistically, and we're not going to get into this on the show, but like, so like when I do my keynotes now and at conferences or Vistage or wherever it might be, I'm like, okay, so like, you know, as we're talking about planning and numbers, and I make this joke, and you know how like comedians, like when a lot of people laugh, you can kind of know there's a universal truth there, Allie. So I'm like, I used to run a $20 million business, and I used to do it like this: revenue, gross profit, checking account, revenue, gross profit, checking account. And every month you just go, what's the revenue? What's the gross profit? What's in the bank account? And then you just keep going. And it's so like one-dimensional, two-dimensional, and you didn't need to know anything in your cash flow statement or any of that stuff, because everything went up for 12 years.
Yeah.
And now you got supply chain issues and inflation issues and interest rate issues and labor issues. And like, it's like, there's all these cross currents. Like you need to know your numbers, because like, if you make the wrong choice, like you could, like you said, if you're just paying attention to the vanity metrics, I mean, it could be pretty ugly.
Yeah, it can be. Okay. So in your framework, you have created a dashboard that provides optics so that an owner can know what direction each of their principles are heading in, essentially.
Mm-hmm. Mm-hmm.
Okay. That's fantastic. Can you talk through and share some of the main ways for a business to increase their value?
So this in principle 4, think about it like when we say grow value, it's truly a concept first. And this concept, because there's a lot of different systems of how you like the tactical how to, the biggest concept, Allie, is the more sustainable, predictable, transferable your cash flow is, the more your company's worth, period, end of story. So you can have two companies, and we have an entire training on this, 2 companies with 10 million in revenue, $1 million in normalized EBITDA. We're not going to get into that right now, but call it proxy for cash flow. One goes for double the value of the other one. Same industry, same everything. Well, why is that? Well, one has more sustainable, predictable, transferable cash flow, and they're So there are a lot of different systems, Allie, that people can go into to figure out, okay, how do I actually create sustainable, predictable, transferable cash flow? John Warlow's value builder system. There's core value. There's something called MOUSE. There's this value opportunity profile by Ken Sangenario. I tend to like his the most. And then every private equity firm and investors are going to have their own way of uncovering your due diligence and your risk. They're going to be talking. So like it, I'll go into Ken's VOP specifically because I like how the concept is about having these 8 functional areas in balance. And these 8 functional areas are planning, leadership, sales, marketing, finance, legal, and operations, and culture. I think it's the 8th one. It's already always hard, but essentially, Allie, these are, whether you have a lemonade stand, your Pfizer, Apple, laundromat, you have these 8 functional areas, just like a house has a foundation. Could be a church, could be a skyscraper. I don't really care what it is, but you need people, you need operations, you need like these things. And so if you think about just truly a baton handoff, Ellie, like if you said, Ryan, I want to buy Arkona, and I handed you a Dropbox, a set of financials, a strategic plan that says, here's where we're going over the next 5 years, of 3 financial statements tied together, integrating that financial or that strategic plan. By the way, here's my management team. They all have tied compensation plans and KPIs to that strategic plan, tied to the financials, the 3 financial statements, and the target equity value. And by the way, then we have to figure out, going back to my example about how, $1 million in cash flow, you pay your taxes. If we had $500,000 left over, we're going to say in 2023, we are going to roll out a new website, an e-commerce platform, an ERP system, hire an executive recruiter for this person, because we have the cash, and every one of those things creates more sustainable, predictable, and transferable cash flow. So it's truly growing the equity value by increasing that multiple, by de-risking the cash flow. And we deliberately chose those projects because it de-risks the cash flow and grows the value.
Okay, cool. I think that is a really fantastic lens for people, because I know that they get to the end of the year and they have cash, they have profit, right? And then they don't do things that invest in the predictable, part of the equation.
And can I tell you, like, the worst thing ever to do at the end of the year right now? So if your CPA says, hey, by the way, Allie, you have a huge tax burden, go buy some cars and a building. Like, I say that so tongue in cheek, and because, like, obviously taxes suck, but when you don't have a foresight and visibility with all 3 financial statements tied together, tied to that future equity value, I don't want to get into the geekiness, but the working capital needed to fund that growth.
Right.
Allie, like I have a client, no joke. Last year, their CPA told them to do this. They bought a $1.5 million building, put $4 million into it so they could mitigate some of these taxes. They ran out of working capital for payroll in May this year. Like that CPA should, like, you know what? All it is like, hey, it's so short-sighted. It's like, but they're in construction. If they're growing, they need people and stuff that they need to buy for next year. So it's all of those things should be tied to that long-term plan.
Yeah. Such a horrifying example. Thank you for sharing.
It's just absolutely true. I got dozens for every one of those.
I bet. Let's talk about the kind of the flip side of the coin, because you need to have both sides. So what would be some exercises that someone basically can go through to help them understand truly what they want and why out of their business?
Some of the exercises from our training that are not anything crazy revolutionary, but like I have this like exercise, and you'll probably get a kick out of this because your gig is like, I have like a leadership. So it says leadership role, and there's a left-hand column that says, what shit you don't like doing? Like, seriously, what do you hate doing? Like, and then on the right hand side, what do you like doing? Because so many founders or even executives think that they just have to be doing what they're doing all the time. But it's like, if you're growing and you see that cash flow growing, it's not a matter of, in my mind, being forced to do all this stuff. It's like, when can I get rid of this? So as an owner, when can I get rid of my CEO title and hire a CEO? Oh, when my distributions, I can maintain my annual income through distributions and afford that person. So I think it's really like one of the exercises, like, what do you want from your role and how you're going to spend your time separate from your asset? And also like, not just the activities, but like we have this thing called the vision wheel, which is how integrated into the business is your identity, your sense of passion, your sense of purpose, your sense of community, your sense of, social life. I mean, Allie, it's real, man. When I talk about when I sold, it was like someone extracted part of my identity. Everything I was good at, all my friends, all my vendors, all this stuff. Like I wasn't able to talk to anybody, do anything after that. So I had to like completely reinvent myself, which sucks.
Mhm.
So I think it's about understanding the role identity infusion, as well as like, what do you want from your role? And just then starting to honestly spend some time with people like you thinking about it. Cause I think the thing that you probably do a really good job at is like helping people think through that, then put a plan in place. I'm just acknowledging like you need to figure it out, because I can't build a plan until you figure it out. But like, it's kind of stopping there. It's kind of skimming to the like, hey, here's some rough exercises to think through it.
Right. I think you bring up a really excellent point that I mean, we talk about like their identity association with business at every level, but especially at the founder level. And so I'm hearing you say, like, I would think like, make sure you are passionate about it and you are committed to the community. And like, I would like be plugging people into making sure that that is like solid. And I'm hearing you say that it's really important to actually have it be balanced and not entirely associated.
It, I actually, when we do that exercise in the training, I truly say there is no right or wrong answer. All I'm trying to do, Allie, there's this, I can't remember for the life of me what podcast I was listening to where this was on there, but there's this. So if for the people listening, I've got my hand that's kind of like at like the horizon, and then one that's like slightly above it. And it's like the delta between the bottom hand, which is reality, and the top one, which is expectations. We want to shrink that so expectations and reality are like in sync, then we're happy. And so going back to your point, like I want people to be happy. And so by being aware, then you don't do things that are going to make you unhappy. So if I would have known that I had a big role identity infusion, I love my people, love my culture, I wouldn't have sold to a third party that gutted the company. I would have probably grown more value, done an ESOP, and participated in the business for the next 30 years. Choice.
I so appreciate like saying like what would you have done differently, knowing what you know now, and having the opportunity to have hindsight, right?
It's painful.
It is super painful. I think another part of your story, which is just so incredibly real, is that you built this asset, and then you do get in the room with a bunch of suits, and it's like it is literally like gambling. And then what you end up with, then the government takes its portion, the broker takes its portion, the attorneys take their portion, and it just goes on in debt. And then like, you know what I mean? Everything from there. And I call it the Plinko, Alley. It's like, you know what I mean? Like at the very end, you're like kind of sitting there going, what the hell, man? We're the ones that built all of this, and everybody got their money before us. Totally. And there is a way to actually measure and monitor. So if you actually build your statements, your 3 statements, like a private equity firm would, with your income statement, your balance sheet, your cash flow statement, you could actually build in your normalized EBITDA. You could build in a hypothetical multiple enterprise equity value, and actually have it a range of net proceeds on a monthly basis. So like you can always say, like, I mean, out of the blue offers are happening all day long. You probably have it with you and your clients too. It's like, well, how do you know which one to entertain? Well, it's like, I know that I want $10 million equity value company in 2030, and my net proceeds are going to be 8. And if someone gives me an offer, I can say like, here's what I need. And like, here's the plan. Should I entertain this or not? It's just a quick, easy, yes or no, and keep going. Yeah. And I think there's also like a very convoluted understanding of what goes into a valuation itself. And it's actually rather simple. It is not that complicated. It's the due diligence part that's complicated. And so do we have enough time I can describe? Yeah, I'll be quick on this, a couple minutes. Is that I agree with you, Allie. And like, I think about like fair market value, book value, equity value, enterprise value, discounted cash flow, multiple of revenue. I mean, like that usually, fire sale, asset sale, like stock sale, like all this jargon. But like
that doesn't do anything for us to be able to make actionable decisions today, to get alignment with the ownership and executives of like, what are we marching towards? But what we can actually plan on, and I don't know if this is where you're going with your comment, is like, so I like to compare two, like a framework of thinking about valuation. So there's the intrinsic financial value of a company, which is the value of the company as it stands today, as an owner owns it without selling. That is the value of the business based on the risk of the cash flow. And we can absolutely figure that out through the discounted cash flow and like just truly saying like, hey, what is the risk of this asset as it stands based on the things that we were talking about, knowing that you don't have a buyer there. So like, I want to eliminate people's narrative of like, I'll never know what my company's worth until someone's willing to write a check. And that's total BS. Yeah. Private equity, the whole industry, and ESOPs have proven that it's not true. And so like we can do that as other founders. And then I want to compare the intrinsic financial value, which is different than the strategic transaction value when a buyer and a seller come to the deal table and the human emotions and strategies are wrapped into it. And there's the purpose of the deal. And that is going to inflate the intrinsic value for a premium or deflate it for and discount it for different reasons. The premium could be like what I did, gut the company and you get a premium because of various reasons, or family estate planning. They discount the company and gift it to the kids. But it starts at that knowable number, like you were saying, which is 100% based on the risk of the cash flow.
Period. And people, I hear it all the time. I have no idea what it'll be valued at. And it's like, you can know your value now and align it to where you want to be going. So thank you for that. What I have super appreciated this conversation. I actually have a ton more questions, but I'm gonna do a wrap up and make sure that people know what the best way it is to connect and or follow.
Website, arkona.io. It's ARKONA.io. And there's 325 podcasts. There's videos about the training. There's more information that they could ever consume without ever talking to us. So just go. And then LinkedIn is the easiest way to get in touch with me.
Outstanding. Ryan, thank you so much for your time today. It's been truly a pleasure speaking with you.
Allie, thanks so much for having me on the show. I appreciate it.